Uber stock is committing a 187 on Lyft, and we've got to get into it and talk about it on today's video. What is going on, investors? Hopefully you guys are doing well out there. I wanted to pick up the story of both Uber and Lyft. We're going to combine both companies. They both reported earnings this week. Very interesting situation where you do see this in the stock market, but now it is playing out right in front of us as an investors. You have one company, it appears, that is about to crush another company in terms of its competition, in terms of its business, and I wanted to show you that because these are some great opportunities, and I think there's going to be an opportunity with Uber here in the coming days ahead. Now, I've been watching CNBC. There's a couple of anchors that have just been pumping Uber, and they've been pumping Uber for a while, but they really put the foot on the gas over the last couple of days. And now, look, when a commentator on CNBC is pumping a stock, it really wants to make me sell it, but in this case, it's interesting because you have the competitor in Lyft that is completely floundering. Look at this stock, down over 36% today, and I actually predicted it back in August that this company was going to face some hard times. I said sell. It is down over 46% since that recommendation. We'll get into it as we roll through these financials. We'll kick things off with Uber. I'll have some timestamps down below so you can kind of guide through the video if you want to bounce around to each companies that you are interested in. Over the last year, stocks actually down only 14%. I say only, there's a lot of stocks down a lot more than that year to date. This thing is ripping. The company reported their Q4 earnings back on February 8th. Revenue came in at $8.6 billion, up over 48% year to date, or I should say year over year, and that beat expectations by $90 million. Yeah, you got a gigantic market cap on this one. Yeah, it doesn't make money yet, but you're going to pay a premium for a company growing their revenues 48%. They gave you guidance for Q1. It's a little tricky, but more than anything, it came in about what expectations were expecting, right in that kind of high 20s growth rate. And you do see for Uber kind of a flattening out. So when we walk through these financials, you're going to see that mobility. This is your kind of bread and butter Uber ride where they're transporting you one place to another. That was up huge year over year, both on kind of a booking side, which Uber kind of counts as the total money coming in. They're obviously just a platform. They kind of skim off the top and take a commission, if you will. Well, it was still up 94% from a revenue perspective. And so that business obviously has come back. It's going to start to flatten out. The growth rate in that is going to flatten out. But you also have the delivery business, which they essentially grew from almost zero. And you also have the freight business as well. The company's done a fantastic job growing two other business models that are now multi-billion dollars from a revenue perspective on a quarterly basis. So very impressive. Obviously, those growth rates have kind of gotten to flatten out, but the company's expecting kind of to be a mid-teens grower for the foreseeable future. Now, the rub is with Uber, hasn't been profitable, but you are going to see management that is actually doing a pretty good job over at this company. Total revenues over the last year of 59%. This is in constant currency. If you want to flatten it out and factor that in, still up an impressive 49%. You've got the very fast growing freight business up 43%. The delivery growth rate has started to flatten out a little bit, up to about 21%, and the mobility up just 82%, just eating Lyft's lunch and breakfast and dinner when it comes to that. Now, from a balance sheet perspective, things look pretty good. Okay, the company has plenty of cash. They have taken on some debt over the last few years, up to about $9.3 billion, but nothing to be overly concerned about because, look, in the past, we might have been a little bit concerned about it with Uber, but they've done such a nice job controlling their cost over the last year. The CEO of this company is doing a fantastic job. From $5.8 billion in revenue last year all the way up to $8.6. Here's the key stat, though. Here's your sales and marketing. From we'll call that 1.3 down. Yeah, that's right. You grew your revenues just we're talking about a massive 48%. And in constant currency, it's actually a lot higher than that. But your sales and marketing cost actually went down. So it's fantastic. Your cost of revenue is obviously going to go up as you have to pay the drivers and the people delivering the food and those types of things. Your research and development ticked up. We saw everything else tick up across the board, but I'm very impressed this company was able to grow their revenues by not increasing their sales and marketing. When you can grow your revenues by not increasing your sales and marketing, it's showing you have a fantastic brand, and people are coming to you without having to be marketed upon. Now, your total costs and expenses over the last year went from 6.3 up to 8.7, but look at your loss from operations last year. It actually wasn't that bad, just $550 million. This year, they're at the tipping point of breaking even from an operating perspective. In fact, I would assume they'll be there by maybe potentially as early as next quarter. Certainly by the end of the year, you see over the last year, just trending it right in the right direction. Okay, $3.8 billion down to $1.8 billion. Now, I do want to emphasize, we're still talking about a $71 billion company. Okay, so you've got a massive valuation on this one. A lot of this is already priced into the stock. So it's not like we're getting this at a bargain basement price. So it's not a stock I'm going to go run out and go buy right this second. But we'll talk about this from a technical perspective. Things are actually going to set up probably relatively nicely. Earnings per share, not something I would pay attention to over at this company. It's really these operating profits going to likely start to materialize in the quarters ahead. And on top of that, it doesn't appear they're going to have to spend more on sales and marketing to continue to drive that revenue growth. From a cash flow perspective, you pull down a net income number of $600 million and you come down here, it's still negative cash flows, okay? But it's basically at that kind of break-even point. So the challenge with Uber, in order for this stock to not only hold the valuation that it's at, and that's obviously critical if you're going to be buying a stock, at the very least, you want to essentially have it hold the valuation that it's at, but it really needs to start expanding that valuation. So that's the question that I still have as maybe a potential investor into Uber, is how are we going to continue to expand if Wall Street is expecting us to go to kind of single or mid-teens growth rate on our revenue side? Certainly, we'll talk about Lyft here in a second. It certainly looks like the competition is going to be floundering a little bit, and maybe you got a little bit of autonomous. Maybe you'll be able to reduce kind of the cost of goods, which is the largest line item on the cost side. Off of $8.6 billion in revenue, you had $5.3 billion in cost. If you're able to shave that down, which at the current time, they're not going to be able to do, they're going to have to continue to pay these drivers more. You see the regulations out here in California, certainly New York City, the two largest markets here in the United States. They keep putting pressure, upward pressure on those cost of sales in terms of the salaries and the driver benefits. And so, the company's going to have to solve that issue at some point because we're still not generating a lot of positive cash flow. You see for the full year, they did squeak out a little bit of positive cash flow. But again, we're talking about a $70 billion company. So if it was a $7 billion company, we'd probably be, not even recording this video. We'd be out buying this stock hand over fist because this certainly is looking like it's going in the right direction. But $70 billion company, they've still got a ways to go to just simply grow into that valuation. Now, the good news is you don't have a lot of CapEx. You don't have a lot of spending on this company. They don't do a lot from a cash burn perspective. So anything that flows into the positive cash flow in the future, certainly if we get into the billions of dollars, that will be very beneficial for Uber. Now, what we've seen with this stock and a couple of other stocks that we've been watching here on the channel, they were locked in these downward channels. And more recently, Uber actually broke out. And this is kind of the momentum breakout trade that a lot of traders that I know and I respect and I follow from afar, some of them that I actually know closely, this is their favorite trade, is actually some type of breakout trade from a downward trend. Once you break out, boy, you can have a large move. This broke out at the $20 level to, $28 level, and it popped all the way up to about $38 in a very short period of time. And we're talking about just a matter of days. Now, the other technical pattern that typically sets up when you have that type of just overbought kind of momentum is it tends to give it back, and it wants to give it back to the top of the channel. And depending on how you want to draw this channel line in, it could come relatively soon, and it would be probably anywhere south of, I would say, about $30. I think if you're interested in Uber and you're comfortable with the $70 billion valuation and just simply break even profits, break even cash flows, and then going to kind of a mid-teens grower. I'm still not 100% on board on this one, considering the lofty valuation, the relatively modest revenue growth. I don't know if that's going to be enough to print enough operating profits, enough cash flows to keep investors interested at a $70 billion valuation. But everybody is in their own boat, and there's certainly people on CNBC that's going to be pumping this over the next couple of weeks or months ahead. Anywhere south of 30 would be your opportunity. So you're looking at maybe another 10% drop in this one. You start to get a back test to this line that would be pretty common from a technical perspective, and I'll show you what that actually sets up. So you back test to the top of the channel line somewhere in maybe the $28-30 range, and that would be setting up a new higher low. You would expect a rebound from there. You get a rebound from there, it's more than likely to outpace the highs that we made back here just earlier this week, about $38. In fact, you'd probably push up into the 40s on that one. You'd go from about 25 to 40. So there's some trade setups here. There's just some interesting fundamental things as well. The fact that this company is doing a fantastic job growing their business, and it is all coming at an expense to a competitor, which is Lyft. Over the last year, Lyft is down 76%. Year to date, this one hasn't caught the rally rush, down 7%, and that's mainly due to the fact the stock is down over 36%. That's right, 36% in one day after reporting their earnings yesterday. Revenue coming in at just $1.2 billion. That was 23% growth. So we saw over at Uber nearly double the revenue growth. That spells bad news for Lyft. The customers are leaving Lyft and they're going to Uber. Now, the good news for Lyft, and the good news for anybody that for some reason wants to take a bullish bet on this stock, you've got just a $6 billion valuation. So Uber is valued 10 times higher than that. That should put a floor at some point underneath Lyft from a valuation perspective. Also, that makes Lyft a takeout target. While $6 billion is quite a bit of money, you have to assume there'd be somebody interested in this business, okay? Whether it's an autonomous vehicle maker, whether it's somebody in that autonomous vehicle space where they could introduce Lyft and have that platform, maybe run the traditional business for a year or two, scale up an autonomous business, and then all of a sudden have a platform where they're able to launch from that and a huge customer base that they can market to. We'll see if that ends up happening. Also, you could, I guess, assume that Uber and Lyft could eventually combine from a regulatory perspective. Anybody that's been following things happening in Washington, I'm just not exactly sure if Washington would allow that, but I guess the two companies could find that out. Now, the company came in at $1.2 billion. That was for Q4. We got a little bit of Q1 guidance as well. Revenues expected to be between $975 million up to $1.1 billion. Again, that's for the upcoming quarter, the Q1. I see Wall Street estimates are now at about $976. Before announcing that, they were actually at $1.1 billion. So just the ratings downgrades, the earnings estimates have come in. That would represent about 11.5% growth. And this company is expected to be just at the double-digit growth rate, maybe the high single-digit growth rate. That's just underneath where Uber is. But the problem with this company is you're going to see it's not profitable from an operating perspective, and it's not at that tipping point which we saw that Uber is. From a balance sheet, this company can hang in there for a little while. It's probably got, maybe another year and a half worth of cash here. They do have some long-term debt. They've levered that up over the last year. When you come down here to the financials, it does paint a different story than what's going on over at Uber. You did have year-over-year revenue growth from $3.2 billion up to, we'll call that $4.1 billion. We are getting kind of yearly results here. Here's your sales and marketing. That ticked up, went from $400 million up to $531. The problem is this company's not at that tipping point of profitability. You see, despite the higher revenues, you had accelerating costs from $4.4 billion up to call that $5.6 billion in costs. that accelerated your loss from operations. Last year, you're at 1.1 up to 1.5. So there is no like tipping point with this company is what we're seeing over at Uber. They're on the tipping point of GAAP profits, GAAP operating profits, probably GAAP net income as well over at this company. We're not seeing that over at Lyft. And it looks like you're going to have to wade through at least another 12 months, maybe as long as 24 months before you see anything like that. Now you got your year-ended cash flows. Those also went in the wrong directions. You pull down that net loss number of $1.6 billion. You get to add back and subtract things, including a massive amount of stock-based compensation over the last 12 months to the tune of $750 million. Last year, it was at $724. In 2020, it was at $565. So that keeps going in the wrong direction. You keep diluting the shareholder, the common shareholder out there. And look at your cash flows. They went in the wrong direction. You like to see them double, but not in a negative way. You went from a negative $101 million in cash flows down to $200 million, close to $240 million, and that's negative. So the company over the last 12 months burned through about $140 million in cash. Again, we talked about on the balance sheet, they have a fair amount of cash, and so they're going to be able to survive things, but it's going to be difficult for them to raise money. And again, they're up against a competitor in Uber that is just looking super strong. And look, I don't want to pat myself on the back all the time, but Lyft back in August, this was obvious. Okay, Lyft has nowhere to turn. I said sell. Their targets for 2024 were too ambitious. Yes, the valuation of this company is not wildly overvalued, which you could argue Uber is, but it just is not going in the right direction. And you see here with the stock price, it temporarily, more recently, kind of broke out above the channel. We actually saw this with Uber, but that is the risk. You break out above the channel and then boom, you are right back into it. I mean, the stock is all the way back down here at about $10 per share. Good news for the stock is it should actually find some support down here somewhere at $10. So there's probably some shorter term stuff. If you like high risk, high reward, you know, look, anytime you're betting on companies with this poor of financials, you have to have some kind of stop loss. There's probably options contracts in here that don't have large premiums because it's such a cheap stock. So, you know, look, if you like high risk, high reward stuff, that's not something I'm going to really preach here on the channel, but there's going to be some opportunities. You're now down here at the bottom of the channel. This stock, I think if they are smart, will start to look for strategic opportunities to sell the company, as you've got a $6 billion valuation that likely probably doesn't even include the 36% drop. So this company is worth even less, and there's certainly some synergies here. Uber's probably maybe potentially kick the tires at maybe making an offer on this company, because the two companies combined would give them a dominant position. We'll see what happens, but right now what is playing out is Uber is absolutely on fire. They're firing on all cylinders. They did the very smart thing and got into a delivery business when their mobility business was essentially shut down or very much reduced during the pandemic. They also have gotten into the freight business, which is growing at, you know, one of the fastest growing companies or business units inside the company. And I tell you what, you continue to grow that kind of in that 30-40%, you're looking at a business that's going to become relatively large. In fact, that business might become bigger than the food delivery business over at Uber. You got one stock that is executing, and year to date, even despite a drop today, is up over 35%. And you got another stock that is doing a terrible job, and that is why it is down big, not only today, but year to date as well. We'll certainly keep track of this story as it moves forward. That was Uber and Lyft. We'll be back later today for the Fang Stock Recap Show. Thanks for tuning in for this video. We'll see you again soon. Good luck with your investments.